Daily bias is one of the most complicated ICT concepts, but you will see how easy it is in reality. This will be the only ICT Daily Bias video you'll ever need, as I'll be covering everything from what is ICT Daily Bias, why is it important and common mistakes, the relationship between PD arrays, top-down analysis, order flow, and bias, finishing up the video with 5 proven methods to find daily bias with examples. If you appreciate my content, then make sure to share, like, and subscribe. Let's get into it. So starting with daily bias, what is daily bias and what are the mistakes that people are doing when it comes to daily bias, thinking that daily bias is what's stopping them from being profitable. But the reality is maybe sometimes following the daily bias is what is stopping them. Okay. And it's not following the daily bias or the proper daily bias. It's thinking that this is daily bias. What they're doing is daily bias, when in reality it's not. And I'll explain how that can affect you. Now, first of all, daily bias is the process of anticipating the direction of, in parentheses, daily candle. You're gonna understand why having this in parentheses. It's expecting where the daily candle is going to. So we have a daily candle. We're expecting this candle either to be bullish or bearish, and in what direction to where. What is the target? If we're moving internal, external, external, internal, we're moving to a specific high, a specific low. We're looking for. Now, why we have daily candle in parentheses? Because this is one of the mistakes that people are doing, and I bet that this is one of the reasons that you are being unprofitable. How is that? Imagine you trade 15 seconds or you trade 1 minute time frame. Do you actually need to know where the daily candle is going to? Not really. Maybe it's going to be a plus for you, but it's not needed. And sometimes, even if daily candle is going up, right, it's a bullish candle, you could take longs and still lose. And you could take shorts, but win. Why is that? Because daily bias is not what you need. You need a 15 bias in that case. So it's all about the time frame alignment, the proper one, the valid one. That's why we could also look at monthly bias. We could look at weekly bias, daily bias, hourly bias, 15-minute bias. So it's not daily bias what you need. You might be needing a 15-minute bias. Maybe you're lacking a bias of the weekly, for example. So if you're looking for swing trades, for example, which you're looking for the expansion of the weekly candle, do you actually need a daily bias? Not really. You might look for weekly bias instead. Now, the other mistake beside the time frame alignment is that you should follow the bias all the time. So let's imagine that we have a bullish bias. I'm only looking for bullish trades or long trades. Now, that's not the reality. The reality is that we could actually look for trades against the bias. Sometimes it's gonna be an expansion market where you cannot take longs, right? Because there are no enough retracement. How can we deal with that? It's by looking for counter trend or against a bias trade. And sometimes I do take those trades and be more profitable than following the bias. So how is that gonna be? We have, when we are following the bias, it's gonna be a big part of the X candle. X candle could be daily candle, could be weekly candle. So let's say if we're following daily bias, then there's gonna be a big part of the daily candle, which is going to result in higher reward to risk and higher win rate. That's the advantage of following the daily bias. Now, sometimes you could also look for trades against the bias. If they are high probability, if you're confident about them, you could also take them. And that's going to be catching a small part of the X candle, in this case, daily candle. But that's going to be lower reward to risk and lower win rate, because in reality, the probability of your trade working out is much, much lower when you are against a trend, unless this is your trading plan, unless this is your system and you know the percentage of the win rate of it, then yeah, that's not going to be applicable. But most of the time with the trend, the probability of your trade working out is better than against the trend. But this is the mistake that a lot of people doing, is just thinking that you should follow the bias all the time. Now, that's a mistake that I was referring to, which is understanding with the bias and against the bias moves. So when we are against the bias and it still work, I do take such trades all the time. but you can always expect less reward to risk. Now, short-term moves, this is what I call it, short-term move, which is a correction or retracement, that's going to be against the bias. What does that mean? You see how we're going up, and this might be one daily candle, but inside of it, this is what you see, okay? And we have a major drawn liquidity right here. Now, we know that price is going to be reaching that drawn liquidity, but how it's going to reach it is not like this. It's not how we see it on the daily candle, because daily candle doesn't show the details on what happened on the 5 minutes, on the 15 minutes, or maybe 1 hour. Okay, but when we go into the lower time frame, what we see is price going up, coming lower, going up, coming lower, going up, coming lower, and then reaching the drawn liquidity. Now you see those moves. We have expansion moves, we have correction or retracement, we have expansion or impulsive moves, and we have correction. The moment we break sector or we take liquidity, we retrace lower. If you know that, okay, it's time, if you see divergence, if you see price going into a POI, then you could take those moves against the bias. But you see the reward to risk ratio here, from here to here, is lower than from here to here. You see? So that's what you need to expect. You could also take against the bias, but you need to understand that they are lower in reward to risk. Now, long-term move, and this is with the bias, those are going to be impulsive move and expansion moves, whatever you call it, the same thing. Now, what does that mean? Well, with a bias, we see impulsive move. This is your, with the bias move. Then we get the retracement. This is against the bias. You could still take it if you're confident, if you see, enough confirmation here. Price is going lower, and then again, we get the impulsive or the expansion. Those expansion moves are with a bias. Those retracement moves are against the bias. So you should always, before taking any trade, determine, is it a long-term move or is it a short-term move? Why? Because that can give you an expectation and a hint about the reward to risk. Now, bias is nothing but a top-down analysis. That's what you need to understand. So following the valid and the proper top-down analysis can lead to having the proper bias. Okay. Now, I mentioned this a lot of the time. It's the top-down analysis that we need to follow. It's the right time frame alignment that we need to follow. So let's say I'm taking an entry on the 1 minute time frame. Do I need to be aligned with the monthly time frame? Not really. If I'm trading the 5 minute, do I go to look at the trend on the monthly? Not really. And that's what actually some of the people on YouTube goes over monthly time frame, sees that, oh, we are bullish here, and if the trade that they're doing on 15 minute, for example, it was bullish, they're gonna go to the monthly, and it's all about the discretion. They're gonna say, oh, it's bullish on the monthly. If the trade was bearish instead, they're gonna go to the monthly, and they're gonna find a reason to tell you that it's bearish on the monthly also. But that doesn't matter at all. You don't need to watch the monthly time frame when you're trading in a 1 minute time frame or 15 minute or even 1 hour. Okay, that's the reality of it. So we need to follow the right alignment of the time frame. So when we move from higher time frame to intermediate time frame, or when we move from intermediate time frame to lower time frame, we skip one time frame here. So for our time frame, if we want to have this as our intermediate time frame, or if you're only dealing with two time frames, so we're only looking for higher time frame and the lower time frame, there is no need for intermediate time frame. What we also do is skip one time frame. So we could look at 4 hour, then skip one time frame, so no 1 hour, 15 minute. What we have now is what? 4 hour and 15 minute, and those are the time frame or the valid and the proper time frame alignment, or to the top-down analysis. It's 4 hour higher time frame, 15 minute lower time frame. So if I'm trading the 15 minute time frame, what I need mostly is the 4 hour bias. Okay, that's the reality of it. Now we could take the daily here, no problem. Weekly, it's a plus, but the minimum is the 4 hour, and that's what mostly I want to focus on. Okay. Now, if you're dealing with 3 time frames, you could go with 1 here, skip one, and you got 1 hour. So monthly, daily, 1 hour. This is here. You see it? Monthly, daily, 1 hour, or weekly, 4 hour, 15 minute, or 4 hour, 15 minute, 1 minute. Now, you need more information about this, how to apply those time frames in order to translate it to a trading plan. I have a full video for you that's going to be suggested now. It's a full trading plan based on top-down analysis. But this is what we need for now. If I'm trading the 1 minute time frame, I need 15-minute bias. Okay, that's the minimum understanding of it. So actually, top-down analysis leads to a bias. Some people would actually go and say, okay, this is how you get your, or this is how you perform your top-down analysis, and this is how you get your bias. In reality, it's the same. When you have, monthly aligning with daily, that means you are with a bias, right? That's it. When you have 15 minutes, you're saying, oh, 15 minute is bullish. Then you go to 1 minute time frame and you're looking for a long position. That's with a bias, because that's the bias that you need. It's the 15 minute, not the weekly. We're not trying to catch a trade on the 1 minute time frame and trying to catch the weekly expansion. That's not gonna work. Maybe it's gonna work sometime if you're lucky. Maybe it's gonna be once a time thing, but it's not gonna be all the time. It's not gonna be consistent. Trading is all about consistency. Now, in order to understand bias, we need to understand two things that the market does all the time, 24/7. And you could go to any chart, any time frame, and you will see that anything that happens on the market, it's gonna be one of those. Okay. Now, either the banks do this or it doesn't do, but you can see it on the chart, at least for us, that we can recognize those things happening. Now, I don't care if anyone says that this is what banks do, this is what smart money is. I don't really care. You gotta go look to the chart and see that actually what is happening in those two things. Rebalancing fair value gaps, you'll see that there are gaps between three candle. So there is one candle, 1 and 1. There is a gap here, which is the fair value gap or the imbalance. You'll see that a lot of the time price comes back to those and started going lower. Or same thing here, comes to a fair value gap, started going higher. So one of the things that market does is rebalance fair value gaps. And there might be some tiny and micro things that the market does, but you will see that in reality, and when looking at the higher picture, it's going to be only one of those. Now this is 1. 2 is looking for liquidity, and let's forget about liquidity. Let's just call it old highs and old lows. Okay, price will tend to go to those levels, high taken, low taken. That's what the market does. Okay, so it's either rebalancing fair value gap or seeking liquidity. That's what the market does. When we have understanding of this, we can actually establish a bias based on this, because if we are in a fair value gap, what are we expecting now? The market to take the liquidity. And the same thing, if we have a clear fair value gap that is unfilled, what are we expecting now? For that fair value gap to be filled. And that establishes a bias, because now if we have a fair value gap here and we are up here, our bias is going to be for this fair value gap to be filled. Now, yes, with the proper confirmation here, but those two things and the understanding of them will lead to a valid bias. Now, we could get a hint of the daily bias or any bias based on PD arrays and the order flow, because order flow is generated and understood from PD arrays. Order flow and PD arrays, it means nothing but the respect and disrespect of PD arrays. Most of the methods that we're going to go over later are based on those things. Now, bullish bias with the use of PD arrays is going to be price retraces into bullish PD arrays and respect them going higher. Going to be also price violating bearish PD arrays. Price retraces down to engineer liquidity. So price is going to come lower, and price is going to sweep those short-term lows. So it's going to come lower and then sweep them and then reject higher. Also, price creating clear breaker structure with displacement. You'll see prices going lower, sweeping liquidity, breaking structure with a displacement to the upside. So the moment we see those things happening in the market on the price action, we can simply confirm that we are in a bullish bias. Now, the opposite is with a bearish bias. It's going to be price retracing into bearish PD arrays and respect them. It's the respect of PD arrays, and it's the sweep of the highs in order to go lower, and it's also the breaker structure to the downside with the displacement. Its price going higher, sweeping those liquidity low and going lower. Actually, it's not short-term lows here, it's short-term highs. So this is how we get a hint of the order flow, which is nothing but a bias using what? Using PD arrays. And any method that we're gonna go over, you gotta use PD arrays in order to understand the bias, because PD array tells you where price is going to, where price is reacting from, and where price is hitting to. This is what PD arrays tell you, and this is what actually bias is. Now, method one, and with the right time frame alignment, it's nothing but, and it's actually the easiest one ever. So whenever you see this, you know what your bias is, and you'll be sure that this is your bias. What is it? So it's the rejection, or liquidity sweeps, or turtle soups. 3 names for the same thing. How does that look? So we see we're going higher here. So let's say we're going higher here, creating this high, going lower, creating this low. So we have a range of a high and a low. Now we started going up. What happened here is we did not close above this high. So you see the swing high here, we actually rejected with a bearish candle, and we were going lower from here. So we rejected from the previous high, we did not close above it. What is this? A rejection, right? So that's a rejection, closer below. That means we are bearish now. So you see we're bearish until what? We took this low, the same thing. That's right here is a rejection, not closing below, which establishes a bias to the upside. Now, what is the opposite of rejection? It's a closure above or closure below. You see what happening here instead is we're going lower, going up, coming lower. Again, this is a retracement, a valid high in this case, a valid pullback. We actually closed above it. Closure, on the other hand, establishes a continuation. So rejection equals reversals, right? And closures equals continuation. Okay, that's how we look at it. So we close above, that's a continuation. And you see here, even though it's a bullish candle, in this case, we did not close above this previous old high. And what does that establish now? It establishes a bearish bias. You see, we're going to the lower side. Now, if this happened, we close below this old low, most likely we're going lower. If we sweep and started going higher, then that's a bullish bias, either coming to an internal or taking the high. So that's going to be the bias. Maybe here, going lower, or going higher, taking that high and started going lower. So this is the first method, and I put it as the first one because it's the easiest one. It's really the easiest one. It's one that you can see it clearly with the right time frame alignment, and I'm going to show you examples now on how to apply this and get a bias based on it. So now into the examples of finding daily bias using the rejection method. Now, one thing is it's not going to be, maybe sometimes it's every high and low, but in order to have really the best bias and the valid ones, you're going to use your experience in order to know, looking for inducements instead of just any high or low, looking for ranges, highs and lows, looking for time-based highs and lows. So a lot of things here. So some of the things you're going to use discretion with it, but you could also just apply a fractal indicator that's going to mark some valid highs and lows for you. Okay, and I did give all of the settings in my indicator video, so make sure to also watch that. Now, just simply by looking at the 4 hour, and when we're looking at 4 hour, what are the time frame used for entry? Simply, it's the 15-minute, right? That's the thing that we already discussed. Okay, 15 minutes. Now, 4 hour, 15 minutes, which means that which means that the bias that we're gonna establish here in the 4 hour, we're gonna go to 15 minutes in order to enter. Now let's take a look at this. We got this low here as an inducement. It's whipped here, right? And we did not have a closure below, which means that we are bullish in bias. And you see here, we close above this high, which means that we're still bullish. I prefer to see retracement first. I don't want to enter immediately on the breakout, okay? You can see that, okay, we did not take this low not taken. This low right here is taken, and we only rejected with a wick. Now let's see this one. It's a small wick, yes. So this one establishes a bias. This right here, we actually closed above. Okay, this one right here, let's see. We got this one. We did not close above it. Oh yeah, this one. So this one, this low here, which is a valid low, we did not close below it, which means that we are bullish in bias. Now, if we just go lower in time frame here to 15 minutes and show you the ranges that you were able to trade based on this method. So 4 hour, we go to a time frame. Actually, this one here, we got a rejection, so we are bearish. But you always want to look for the valid ones. So for example, want to look for high taken with the overlapping, right? And also you could look for overlappings, rejection from here, but this is an advanced level. We could look for price rejecting from those levels, which means that we have already a bias. Now those are the same levels that we marked in the 4 hour, but this is on the 15 minutes. Let's look at how price behaves after, given that sweep. So you see we got the sweep, we already got the rejection here. This was agent session, so not really a big fan of trading in the agent session. But you see after the other sweep, we just started going higher, and that's your bias. The probability here of taking a long position is much higher than taking short. So you see price respecting period arrays. You see a very clear order flow of a bullish one, right? A bullish order flow here. So you could look for long positions here, and you see we started going higher until what happened? We got this one. So here we got a rejection of a level, 4 hour one. We started going lower. We got a retracement into that fair value gap, and we pushed lower until when we got another rejection of a 4 hour level, and we closed above. That establishes what? A bullish bias. Now we were going bullish until this point. The more recent the sweep is, the better for you. So when I have a sweep here and it's already rejected, it's better to enter here than wait somewhere in here, because the move, maybe it's about to end. Okay, so it started going lower, and same thing here. We sweep and rejected. This one we're not gonna be able to participate in because it was news and you got no time here to participate. What happened here is price sweeping a low on the 4 hour, already rejected. You could even look for what? An OTE here. So from this point to this point, we got OTE right here. And you see almost 61%, and the 0.5 price pushes higher. And you see it's a bullish order flow simply. And we started pushing higher from that point, going higher, maybe until sweeping another one. So that was a closure above on the 4 hour. What do you see? Price went above and then immediately came back to the range. So if you're experienced enough and you know that price is coming to the specific point, even if there is a closure above, but then you see immediately price rejected, you could still count this as a sweep. Why? Because if we have a closure above a level and then price coming lower in a 4 hour time frame, for example, when we look at daily time frame or even 8 hour time frame, this is gonna be what? Candle with a rejection of that level. This is how it's gonna be. So the closure of a body of a candle does not mean always that it's a breakout structure. Sometimes it's a sweep on the higher time frame, but that's an advanced level, right? Only when you're in a valid higher time frame level. See, when price comes here, even if it was a closure, and then CISD, then this is still a sweep on a higher time frame. Okay, so this is how you get your bias. You should always follow the right time frame alignment. Simply, a rejection candle means a reversal bias. A closure candle means a continuation bias. That's how we look at it. Simply by looking at one candle that establishes a bias on a higher time frame, we go to lower time frame in order to find an entry and execute. That is the first method. Method 2 is external and internal liquidity, or in other words, market makers model. Okay, either buy model or sell model. X refers to either B or S, buy or sell. Now, this is one of the most accurate and high probability methods that you could use. Best one that I use, in my opinion, This is how the market moves, because a market maker's model is nothing but what? Coming into an internal, which is a fair value gap, and taking an external, which is an old high. That's all the market does in one market maker's model. Market maker's model, price coming into an internal, going to an external. That's what it is. Okay. And the market as a whole does only two things, which is sweeping liquidity and coming and rebalancing fair value gap. All what we're doing is what? Looking for this signature in price action, which is price expanding with an displacement, leaving a fair value gap. Retracement into that fair value gap, which what we see here. The moment we see, we look for confirmation inside of this fair value gap, targeting the high of the range. Why is that? Because when we are on a 15-minute time frame, for example, the moment we are in a bullish fair value gap on the 4-hour time frame, that's a bias by itself. Now imagine you're looking at 4-hour time frame, right? And you're inside of a weekly fair value gap, bullish weekly fair value gap. What does that give you? It gives you a bullish bias. It's like, it feels like, oh, I'm about to be bullish, right? That's the psychology behind it. So we are in a bullish fair value gap on a higher time frame. Simply, that's a bias by itself. Now, the moment we are sweeping a high, that's also a bias of maybe going lower. The same thing as the first method. So simply, we're looking at internal range liquidity, which in this case, a fair value gap. So fair value gap is internal liquidity. We're waiting for price to come into that internal, and we are looking for a confirmation here, and then targeting to the external, right? That's how the market moved: external to internal, internal to external. You see from here to here, that's the external to internal, and that's the internal to external. So simply, I really prefer, actually on the first method, it was a trading external to internal. In this method right here, it's trading the impulsive move, another correction. Okay, so this is, just being inside of this fair value gap on a lower time frame, inside of this higher time frame fair value gap, it just gives you that bias. Okay, we're going to be looking at examples here, but I have a whole video about this, about the internal and external liquidity, and how you can actually be profitable using this. And I know a lot of friends, a lot of profitable traders only looking for the signature in price action, which is price coming into internal, trading off to an external. So this is your daughter on a daily time frame. You could apply this on any time frame. It's just that the confirmation you look for should be in a valid and proper time frame alignment. So simply looking at what is happening here, what we had is what? Price going higher, coming lower with the displacement. What does that leave? What do we see here? Fair value gap just right here. That's an internal liquidity. And the external liquidity we have at the moment is this one. What happened is price going into the internal, going to the external. You see, you could have looked for a low time frame confirmation here from the fair value gap. This is the signature. The same thing happening here. We had this internal. Now we go and look for the external. This is our external. And that's what happened. Price going from internal. So price being inside of this internal, it just automatically a bullish bias going higher. Same thing happening here. We get this overlapping. We got this fair value gap, which is our internal. What is our external? It's this high, and that's where price goes to. Price comes lower. Internal, this is our external. That's what happened. And that's the cycle all the time. You see, we're going lower. We pushed higher. We got this fair value gap with the overlapping of the body of the candle here. That's the one where we got the external. It's this one. And that's where price goes to. Now, same thing going over. Sometimes it's going to be against the bias. So sometimes you are actually looking at this, right? Looking at this move here. Sometimes it's going to fail. Yes, because now we might be in a monthly buy. So maybe this is an internal in a monthly, and we're going to be disrespecting this one in order to reach the monthly target, for example, or the weekly. So it's not going to be every fair value gap working. You got to look for the valid one. And I already taught everything about this in one of my videos, and it's going to be suggested now. So we got price coming lower. We got this fair value gap, and we got external here, or this one, and it was respected. The same thing happening over and over. You see, internal liquidity taking the external here. Same thing happening over and over. It happens all the time. And that's how you find bias. Okay, now we could look for weekly, for example, the weekly time frame, and see, do we actually have market makers model, or in other words, a move of internal to external? Let's see. We got this big move, right, from here to here, and we got this extreme fair value gap here that is partially filled. We took this one, liquidity, into the fair value gap. Our external of this move is this one, so that's our target. But then we have some other targets, which is this low here, which was taken. Yeah, I think this one was a valid target, and then extended it to this one. But this is a weekly time frame. I'm not gonna be waiting for this to be taken all the time. Maybe in the future, but not as of now. Okay, so same thing happening even in the weekly. Let's see the monthly time frame. Now, how is that, or how are we gonna utilize this in order to find the bias? We're simply, when we are coming into a fair value gap, that's a bias by itself. So let's see, for example, here we got this move, we got this low here, and this high of the range. Any fair value gap inside of this range, yes, the extreme one is around this level. Simply price coming into this level, it's a short bias. We go lower time frame, look for confirmation, targeting what? I really prefer to see, first of all, we're gonna look for the internal here. So I really want to see price coming into this internal, and then following by price taking the external. And that's what happened. Price going to the external. Now, 1 minute time frame. Do we have this on the 1 minute time frame? Let's see. I'm gonna go back in time, for example, this London, or just randomly going over any day. So let's say this one right here. Okay. Now zooming in, gonna see that what happened is what? Price coming lower with a lot of displacement. Extreme fair value gap is this one. That's where price came to. What is the external? It's this low. That's where price actually took that low. And then we started going lower. Same thing. We got, for example, this one, bearish move. Price coming into fair value gap, started going lower. But this one, we don't have a big range to the downside. I really prefer to see something like this. Price coming lower, going up, a big retracement. So it leaves more space for us to target this low, which is the external. I could have looked at the external of this range here, because now what we have is what? Another market makers model, which is from here to here, and prices coming into another PD array to take the external again. So that's how we establish a bias. Now, the same time frame alignment is what we're going to be following, right? So I'm going to be looking for a market makers model on the 15-minute and looking for an entry on the 1 minute time frame. Let's see an example. What we have here is this one, for example. Yeah, we got this one. So you see, we got the creation of fair value gap here, back to 1 minute time frame. All I want to see is what? Price come into this fair value gap. This is what's going to happen now. The moment we get there, we are bullish. So you see, the moment we get there is we're bullish. I really prefer, again, to see a target around this one, because you see, we were not able to enter here, as well as the target is very close. But if you're entering on this, maybe targeting this high instead, or this Asian high, that also could work. So that's the method. That's the first method. Now this happen again all the time. This is how the market moves. And I do have a full video about this. So I have 2 videos on market makers models and 1 video on external and internal. You can watch all of those, and they're going to be suggested on the video or in the description. To the third method, and that's one that I have, again, a full video about it, where I went on details, the types of it, how we use it, a full trading plan around only 3 candles. 3 candles is really, or maybe sometimes 2 candles is all you need in order to establish a bias, in order to have a trading entry, as well as a POI to enter from. So 3 candle pattern, also known as CISD. Now, just three candle pattern to simplify it to people. What we're looking for is what? Bearish candle, maybe going into another liquidity level. So we only validate this, either this one, or this one, different types of three candle pattern. Again, sometimes it could be two candle. We only validate this pattern when price is inside of a POI. So for example, we got fair value gap, order block, breaker block, or an old high or old low. Also liquidity sweep. Yeah, this is the one that I meant with old high or old low, as well as an SMT. So when we have an SMT and we can see it within this three candle pattern with another correlated asset, then we can validate this pattern. So what is it all about? When we have price coming into higher time frame level, and what we see is price, first of all, first candle is bearish, then a bullish candle, and then the third bullish candle is closing above this one and this one. That's a three candle pattern. It's a V shape on a line chart, right? So when we have a line, it's going to be V shape, and it just looks like, oh, price is coming lower and then going higher immediately. Also, it could be in two candles, which is just simply an engulfing candle. So a bearish candle and then an engulfing candle. Really prefer to see price sweeping the low, right? The same thing as here, sweeping the low. Now it could be bearish candle, bullish candle within the bearish candle, not sweeping it. So it's an inside candle. And then the third candle comes and sweep to the lows, right? Which is now in a low time frame, equal lows, and then closing above both this one and this one. So closing above, that's what? Another three candle pattern that is valid in order to validate a bias. Okay. Now, what is this looks like? Why is this actually a valid pattern, even though it's just an engulfing candle? When we look at those CISD or engulfing candles within a higher time frame level, that indicates a market structure shift in a lower time frame. So you see this one here. If we look at lower time frame, it might be something like this. Price is coming lower, going up. You see this closure here? That could be the move to the downside, could be the bearish move, and the move to the upside is the bullish move or the bullish candle closing above here. You see, it's something like this. This is bearish, this is bullish. Closing above indicates what? A lower time frame market structure shift, and we have a valid one. That's why CISD is really significant, because it's nothing but what? A lower time frame market structure shift. If you want a mechanical way to confirm a market structure shift, you could look for this one. Using the time frame, using the valid time frame alignment, you could actually just look for market structure shift using higher time frame CISD, and that's going to be a very mechanical way. So simply, we're going to be looking at those patterns in order to establish a bias and then look for a lower time frame to enter. So we got 4-hour euro dollar here, and simply all we're looking for is the three candle pattern. You see here, what was happening is, if we go back in time, we can see that we're going up. The first thing we see is three candle pattern, or actually two in here, but it's still valid. This establishes a bias to the upside. We're coming lower. We could also mark the fair value gaps here, that we have two consecutive fair value gaps or a hidden order block. And if you're not familiar with hidden order blocks, then you should watch my video about hidden order blocks. So we have a hidden order block here. We have no three candle pattern. You see, we got a bullish candle, but not closing above the previous one. And you see here, we have one candle, second sweeping, third displacement. That's a three candle pattern establishing a bias. So from here, I know that I'm bullish in this case. Again, bearish candle, bullish and sweeping and displacing, that's a low. Usually those levels, the three candle patterns, gives, especially when aligned with the higher time frame, give you actually an indication of a strong high and a strong low. So this one now is a strong low, that's why it was not taken, strong low, and we started going higher. Now you see, we're going higher. There was no three candle pattern here. We're going up. We got a three candle pattern. Why? We got high, second candle within, third candle market structure shift. This is now is a high that is part of the three candle pattern, which establishes a bias. Now this one is also one that I could count as a bias, but then we're reacting of another high time frame level. So we're looking for this retracement. This is more higher probability than this one. Okay, could have taken this one, and you're gonna know when you apply this in the future that those are high probability ones with a bias. Okay, because that's the whole video about daily bias, short-term moves and long-term moves. So this one from here to here is a short-term move. This from here to here is a long-term move. Now you see, we were choppy here. I really prefer to trade the 1 a.m., 5 a.m. and those candles 9 a.m. because those are higher in probability. I really avoid the candles inside of Asian session. And you see, again, we have this one, 3 candle pattern establishes a bias. This one after sweeping liquidity, we got a 3 candle establishing a bias. I really prefer ones that are reacting off level. So you see, we also sweep this level, but no 3 candle pattern, so now valid. But then when we sweep this level, see, we got sweep of this level, no 3 candle pattern, nothing, and then we got one here. So that's a bias. Now we only look for ones that are valid. I don't want to go in details this time, but this is a valid one. We started going higher, price coming again into what? Again, if you haven't watched my hidden order block video, this is a hidden order block. Price comes here and a 3 candle pattern. That's a bias here. I know that we are pushing higher, and until we reach this level where we come into an order block and sweeping this liquidity, we got a 3 candle pattern that's establishing a bias. In this case, that's most likely a strong high. And then we went lower, same thing you see here, 3 candle pattern within a hidden order block and a fair value gap within overlapping, right? So fair value gap within overlapping 3 candle pattern happening at a key level, that's a bias to the lower side, and this keeps going. So the moment you understand the 3 candle pattern, where to look for it, and what are the the higher probability levels to look for it, using your experience, your discretion in order to filter out the good and the bad ones, you'll master daily bias just by looking at 2 to 3 candles. That's it. So now into method 4, and this is going to be a little bit different than the others method, the 3 methods that I went over previously. This one, you're not going to be able to trade the Asian session as the other ones where you could actually trade any time frame and any time of the day. This one is a little bit different. It's going to be more about, a little bit of a 4-hour time frame and less, right? Mostly 15 minutes time frame. But using this, you could actually catch the expansion of the 4-hour. But I would say mostly 15 minutes. That's your bias for the 15 minute for every day. Trading what? London kill zone and New York kill zone. It's the Asian range sweep, because Asian session by itself and what happened after, especially on the London kill zone, is going to determine the bias for the day. You see here, the Asian range sweep will help determine the bias for London and New York, or New York. So both, either it could be only for London, or it could be for London and New York, or it could be only for New York. And you can understand which situation is appropriate for that day depending on those 3 videos. So if you want more information and really enough information about how to use the Asian range as a strategy and as a bias, then those are the videos for you. All of the videos are going to be in the description. So Asian low sweep, first of all, market section shift and a displacement. So let's say we have Asian range here, sweep to the lower side, displacement to the upside, that establishes a bullish bias. The opposite, Asia high sweep, market section shift. So you have Asia high taken, displacement to the lower side, that establishes a bearish bias. Now simply by looking at those, especially when we have the sweep into a higher time frame PD array in the 4-hour time frame, that's going to be really a high probability bias to look for throughout the day. You need to highlight your Asian session and then what happened after, which is the London and New York. So you see, a lot of the time, what we see is when we have price going below the Asian low in the London kill zone, right? So below the Asian low into maybe a higher time frame PD array on the 4-hour. That's what I prefer to see. And then breaking above with the displacement that establishes a bias for the whole day. You see, for the whole day for both London, mostly for London, and also for New York sometime, we keep going up. You see the same thing happening here. Actually, there is a problem with the indicator, but this is your agent session. This is agent high. What happened here is price sweeping up, coming lower, and there was the market such a shift here. Then we keep going lower for the whole day. Now, this is also happening maybe sometime. It's not going to hold, especially, and that's why you need to watch the other videos, because there are scenarios and conditions. For example, if agent is already reacting of another PD array, then it's already going up. Price is only coming back into the agent session to keep going higher based on the mitigation of the higher time frame PD array on agent. Now, same thing happening here, especially when price is going again 4-hour level, and I'm gonna cover this. We're gonna go to 4-hour level. We're gonna go over 4-hour time frame later. You see, sweep above, coming lower, market such a shift as a continuation to the lower side, as well as continuation also on New York. So still going lower. You see, again, same thing happening here. What happened is price sweeping, breaking structure, and then continuation, or this is the bias for London, and again another until it was ranging here. Now, were we on PD array here? Maybe we go to 4-hour and see. So if you can see what was happening here is only price coming into this order block, right? Into this order block, agent session, sweeping here, and then keep going lower. So that's a POI, even though I was expecting price to come lower, but that's also another POI. So price could go lower, up again, and come lower, right? Another example is this one using a PD array on the 1 hour. We can see that this is our agent session, sweeping the low here, as well as this low into a 1 hour fair value gap. And that's your bias. You see, we had price coming here, and then CISD, or actually a market shift and a displacement on the lower side. You see, displacement to the upside here, closing above, continuing higher for the London. This day was not the cleanest, but it's still working. And the same thing happening here. We got agent session from here to here, and price came to this fair value gap. Most likely also, again, this is a fair value gap on the hourly chart also. Let's see. See this one here, this day. You see, we got agent session from here to here. We swept into this 1 hour fair value gap, and that's your bias for the day. You see, that's also an hourly bias. We're going up, coming lower, and continuing higher on the New York kill zone. So that's how we use the agent session and the agent sweep to establish a bias. Again, same thing happening here. 1 hour fair value gap above the agent session. Price did not go exactly there, but what happened is sweeping liquidity from agent session, breaking structure, continuation on New York, going lower. Method 5, and that's the last method for me, and this is my humble opinion. It's not the high probability method to follow to find the daily bias. However, it's the easiest. It's the the most mechanical one. It's not subjective at all. So it's based on 2 indicators that ICT suggested, and I already had a video about this. You can watch it in the description. It's all based on EMAs, or exponential moving averages. We're going to be installing and setting up 2 EMAs, 9 and 18, and we're going to have them on daily time frame. That's what I prefer to see. But if you are trading on a lower time frame, you could look for the bias based on the valid time frame alignment. Okay, so for example, if you're trading 1 minute, then maybe switch to 15 minutes to look for the EMAs, or maybe 1 hour. Okay, you could be flexible with that. Now, how do we go with this? First of all, I want to see price above both 9 and 18 EMA if I want to be bullish. So a bullish bias would be price above both 9 and 18 EMA. Now, the opposite for a bearish bias, I want to see price below both 9 and 18 EMA. If price is ranging around and hanging around both 9 and 18 EMA, then that means there is no clear bias. It's the same as saying that, okay, price is now ranging instead of expansion. So when you have this condition, it means that the market is ranging, chopping around, and there is no clear direction other than having a displacement and expansion. It's not like this. So when you have this, maybe stop trading. But when you have price below both 9 and 18 EMA, then that's a bearish. The opposite is bullish. Very easy to follow. I suggest if you're a beginner and you have no idea of, PD arrays, external, internal, internal, external, all those methods that I've went over, then you could use this one because it's very mechanical. It's beginners friendly and you cannot go wrong with it, right? Even ICT suggested use this one. And we're gonna go now and look at the examples and look how we can actually approach this one. Now we're gonna go to your dollar for this example. I mean, you could use any asset for this one. We're gonna go to indicator and install this one called multi EMA. You're gonna go to input and have 9 and 18 EMA style. You're gonna apply those two with the colors that you want. Okay, enable it here. And what do we see on the daily time frame, right? So for example, we have, if we start from this point, we can see that price sweep liquidity. What is that now? So sweeping liquidity, rejection means change in bias. So if we're bullish, then we're bearish here based on the one of the methods that I already talked about. Now we have one hint here. The other hint is that price is below both EMAs, which means that we are now bearish. So all those days we are being bearish. Now we're getting closer to the EMA, but we are inside of a bearish fair value gap. We're still bearish until we started going up and we were chopping around here. Then that, not really confident about this until we have a clear move. And at this point, we're above both 9 and 18 with a bullish fair value gap. Could have traded from this one going higher. Now we have another bullish fair value gap and we are above both. Then we're still bullish. Price comes to the EMA. It's, around the EMA. Not really confident at this time. Then we close below aggressively. We are below both EMAs. We could have shorted here, coming lower below both EMAs here again. And until we closed above, I have a fair value gap here and we are above both EMAs. So this fair value gap here could hold price going higher. We are bullish for now based on this method. But when you use this in combination with PD arrays, fair value gaps, then you could actually, take advantage of this and have a higher probability instead of just following the EMAs blindly. You could actually have much higher win rate combining with other ICT concepts. Now you could also do this on the 15-minute if you want a 15-minute bias. You can see that, for this day, we're above the EMA, then that means we are bullish. Same thing happening, for example, on this day. You see on London, we were above the EMA. We have this fair value gap above both EMA. This one was holding, started going higher above both EMA. We're bullish. Again, for New York, the same thing happening. But in my opinion, for the daily, it's much higher probability. Also for the 4 hour, it's much more clear. That's it for the video, guys. I hope that I've done a good job explaining everything about daily bias, going over the methods. I hope that you found one or two methods that you can start using and that are gonna make you a better trader. I really wish you the best. If you appreciate my content and the time I'm giving you for this free premium content, then make sure to subscribe to the channel, hit the like button, and share this video with your friends. You don't know, you might be helping someone who's struggling with daily bias. This is Molham, and I'll see you in the next video.